Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, Mike Khouw, CNBC Contributor and YieldMax Strategist at YieldMax ETFs, and Anthony DeMartino, co-founder and CEO of Sentora. We're here to discuss the Supercycle Shield, and if investors are moving into hard volatility assets rather than buying VIX calls. It's great to have all of you with us as always. Brian, we've had a number of changes, including South America, a jobs report that looks like a typo, yet the VIX is barely budging. Are we seeing a structural suppression of volatility, or is the market just distracted by this commodity supercycle?
Well, I mean, we are getting some level of movement back and forth in the S&P 500. And remember, the VIX and volatility is calculated on how the S&P 500 is moving, or how people believe it will move going forward. And look, I mean, the S&P 500 has kind of been stuck in the mud, really, when you look back at it, on like a 200 or 300 point range. Hasn't really gotten out of that momentum. And so volatility at least seems somewhat suppressed there, even though we are getting some shocks in the system here and there. Obviously, we heard the Greenland news, and then now there might be a deal, whatever. And the VIX is really back in the teens again. I still think there is a level of support in the VIX and volatility where I can own some options and own some protection when we see the VIX sort of get in the mid-teens here. But certainly, Jill, you mentioned the story is been this super cycle commodity play right now, and you know, gold, copper, whatever, really on the move. That seems to sort of be somewhat of the hedge for whatever reason. People wanting to get out of the US dollar, as we've seen it drop below 100 and kind of stay below there. It seems like the commodity play might be the kind of little bit of a hedge people are looking for right now.
Yeah, and Brian, it's interesting because when that move took place on Wednesday, I believe it was around 2:43, 2:44 Eastern, where the reaction when that headline went out that potentially there was a deal made over Greenland, the move really wasn't in the VIX. It was in gold. I mean, that's what everybody was watching.
Right. Yeah. Well, it basically turned everybody back on. Are we going to get, rates lower now? The tariffs are going to be off. Things are okay. But the job picture isn't great, like you mentioned before. So are rates going to be lower? Does that mean that the US dollar is worth less and gold is worth more? And so that's what we saw. So as soon as the VIX, it was like sort of sell the VIX, buy the market. Gold kind of held in there, which is kind of interesting. So the momentum trade on that is still in play. But man, that thing is really overextended right now.
Yeah. So Mike, let's address the defensive rotation. If volatility isn't in the VIX, we saw it in the sector flows, utilities, commodities, catching those bids. Would you say this is a risk off move or a real asset on move?
Yeah, I think that's a great question. I mean, traditionally, people have thought of things like utilities as a safety trade. And I think that was probably true several years ago. It used to be, for example, that you would see flows not just into something like utilities, but arguably staples as well. And if you take a look at the pairwise correlations between those two sectors, in history, they were much higher than they are today. And I think that's because utilities have turned into a different kind of an animal. That's actually seen, I think, now as a potential growth area. Our generative capacity has not really kept pace with, say, China, for example. And people realize that there's going to be real demand for the data center trade, essentially. And I think one of the other ways we can sort of see how this is bearing out is just take a look at the sectors that are best performing so far this year. Leading the way are things like energy, and oil prices remain depressed, materials, and things like that. That's sort of more real growth, I would say. So the way I look at it, I think that there's maybe a little bit more optimism in here than you might expect. And as far as the Greenland thing is concerned, there was a long-standing understanding that the United States was going to be able to operate in Greenland essentially in whatever way they saw fit. I think that part of the reason why this has become an issue more recently was because there's, a little bit of a divorce of sorts going on between Greenland and Denmark itself. And so I think the United States was just trying to ensure that they were going to still have the access that they previously had. And as long as there's a war going on in Europe, I think that's important.
Yeah. And Anthony, let's bring you to the conversation here and discuss tokenizing the market. We've seen the exchanges discussing moving stocks to the chain. What does this actually change for the average investor when you're thinking about the markets going 24/7?
So I think the market's going 24/7 is going to happen whether it's on chain or off chain. I think the real innovation that people aren't talking about is, we have a $63 trillion roughly equity market 40% roughly owned by retail. That's 25 trillion sitting in retail hands. If you dig a little bit deeper, 30 to 40% of the Mag 7 is owned by retail. These are typically younger, more technical and handle their own finances. When you start to tokenize equities, and this is a piece that I think is really powerful and what will threaten the banking revenues top line is once you start to tokenize equities, anyone will have the ability to use their tokenized equities as collateral to borrow dollars. Now, high net worth people have that. Certain institutions have that, but currently all of your equities held at a broker dealer are being used by them and not by you. And if you start to say, I have $100,000 of Apple and I can borrow 50 grand at 6%, I think it starts to disrupt not only the asset allocation, but also can create a big boom as people get access to their leverage on the stocks they own.
Yeah. Well, Anthony, what about accessibility? Let's talk about that for a moment here. When you think about fractionalization and how investors could take advantage of trades, I don't want to say expensive in terms of valuation, but in terms of the amount of capital that's required to invest in some of these stocks where, the cost from a dollar perspective has certainly moved up as we see the expansion in the prices there.
Yeah, I mean, listen, I think the existing stock markets like the Nasdaq are extremely efficient. The costs are really low. I think in the early stages, it's going to be less efficient, honestly, I think, because you already have a super efficient market. But the benefit of tokenization on top of just the access to liquidity is the 24/7 benefit, but also the settlement times, right? We do, the big story around GameStop, and there was a lot of politics around that when Robinhood had to halt trading, was every bank, when they do a trade that has not settled, has to put up capital. Once you start to moving to on-chain settlement, you reduce the capital demands from banks, broker dealers to settle trades because trades settle instantaneously. So that's going to be a big capital relief to banks and it'll allow for more seamless, more liquidity, and probably cheaper trading once we go to tokenization.
Right. So, Brian, let's talk about market structure for a moment here. When you think about 24/7 trading, does it make the market more or less stable when we see some of the shocks through headlines or tweets or through social media and so forth, or even when we're looking at those meme type of trades? Does that impact traditional trading hours? Is it going to impact when we see those gaps within the market when there's not much going on?
I think it kind of depends on the security you're talking about. When you get to some of the large cap names and stocks, I don't think there's going to be much different between that and, let's say, Bitcoin or Ethereum or any of the other cryptocurrencies that trade 24/7. You'll see that same kind of movement. Could you go to sleep Friday night and wake up Saturday and the stock has moved a bit? Yeah, that could happen. But I think the liquidity will be there for the big names. When you get to the smaller names that are a little less liquid, those in market times need a little bit of working and massaging for any institutional order to come in and trade those orders. So certainly that could be some issues where those start to move around a little bit too much and there is some lack of liquidity that occurs in the overnight markets or into the weekend or whatever when market makers aren't providing the kind of liquidity you typically see during the middle of the day. So that would be a little concern, but I think exchanges will be pretty cautious in sort of rolling that out, see how that goes, see where the market structure can keep the liquidity intact. Because certainly we see the after hours trading on earnings or whatever, and that all goes fine. So I think that'll continue. The large cap names will be fine. We'll have to slowly roll out. I don't know if it's ready to be across every single equity, across every board. Let's just say, in the Russell 5000 or whatever. So we'll see how that happens. But certainly this is an interesting concept. Lots of good points that Anthony makes about having liquidity, about basically owning the stock yourself, right? Owning that token yourself gives you a lot of leverage in different places that you haven't been able to see before. And that'll be interesting to see how that all shakes out.
Yeah. And Mike, let's get an earnings pulse for a moment here and look at some things into the week ahead, because it felt like this week was very geopolitical and macro heavy. So, focusing more on the fundamental areas in the market. What's your take on upcoming earnings? Anything that you're going to be watching specifically next week?
Yeah, I mean, I think you're right. Everybody's eyes were on Davos with all the stuff that was going on there. Yeah, I mean, it's going to be a really big week. We've got a lot of names that are in the Russell 1000, large cap stocks that are going to be moving 6-7+%. Some of the names that I think are kind of interesting are potential turnaround stories. One of the examples that immediately comes to mind is Starbucks. So this one's implying a pretty big move. That stock obviously has been severely depressed. We have Brian Nicole who came in there, and there was a question about whether or not he's going to be able to turn the company around. There's been a lot of false starts with new CEOs at Starbucks, but the stock has rebounded a little bit here. It actually has come back to a level, sort of a key level, actually, I would say, as of yesterday. So I think that's going to be one to watch. Obviously, Meta's reporting. We've got Dow. I think that's an important one. And Corning. So, I mean, the list is almost too long to mention, so I would just encourage people to keep their eyes open. But, in the sort of the large cap space, there's probably 20, 30 stocks in there that are implying moves of 7% or more by the end of next week. So there's going to be a lot to watch for sure.
Yeah, that is for sure. And Anthony, back to the tokenization and how the exchanges are thinking about moving forward. How would you say that the bigger banks like a JP Morgan or a Citi, how are they reacting to this? Do you think that they'll need to change their market making operations? How do you think they're going to handle what could be coming?
I think the banks are being challenged both from tokenization, but also from stablecoins. And I know this wasn't one topic we were going to speak about, but this week, Brian Moynihan of B of A was asked directly about stablecoins impacting the banking model. I think, as people decide to move to stablecoins away from fiat bank deposits, that severely hinders both the profitability of the bank and the ability to make loans and reduces the amount of credit in the market. So I think they're getting attacked from both sides. Honestly, I think they're very slow to this uptake. And the way we're seeing them defend themselves, as they usually do, is they're trying to cripple both the Genius Act and the Clarity Bill in Congress. And that's why we saw Brian Armstrong saying he was going to walk away from the negotiation. So the banks are scared. And honestly, I think they need to start ramping up investment, because if the exchanges are going this way and their clients are going this way, BlackRock, Fidelity launching ETFs on Bitcoin and other crypto, I don't think they can wait much longer.
Yeah, it's interesting, Anthony. It seems as if the banking lobby came in out of nowhere when we saw those recent developments that's taken place over the past week and a half in terms of the Clarity Act. And market structure is critical for this moving forward, not only in the US, but globally, right? That's where you're going to get scale. And it kind of is counterintuitive when we've seen such investments from what you would consider the traditional finance sector that they have been making. Clearly, there's consumer demand around these products and, to integrate DeFi and TradFi for a more efficient banking system. It was a head scratcher.
Yeah, I mean, listen, the tokenization and digital assets are a direct threat to banks, because they show the world that there's more efficient technology and people want to own their own assets. This is in one word, it's disintermediation. And you could see how they're reacting in Congress. They're currently scared, and they should be, because, if you think about prime brokerage models, and what these banks do with your stock, they take all the benefits of your stock and give you nothing, right? I mean, in exchange for free trades, right? So that model is being severely disrupted. The digital asset space, and this is not crypto people. This is real banks, real asset managers investing heavily, and I think the banks are behind, and then they need to start making changes very quickly.
All right. Appreciate all of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.